Hey everybody, I'm gonna do another weekly update thing. I meant to do it this weekend, but I got a little busy, just didn't have time. Ran almost 4,000 miles this week, so been pretty busy. But anyway, I'm gonna talk about the S&P 500 targets and all that, and what's changed over the last since my last update on that. I also want to talk about a little bit about bond yields and how it's affecting the markets right now, or my opinion, or what I've learned recently, even with it. Like I say, it's no matter how much knowledge and experience you have, there's always something that you can be learning. You guys might see me as like a all-knowing kind of person, but there are things even I'm learning every so often here, and I'm going to share some of that with you. Okay. So let's first go to some of the data that I normally show, so you guys know where I stand as far as the earnings and what to expect, what I believe is a reasonable price for the S&P 500 and where it's heading in the next year. And then we'll talk about the bond stuff. All right, so hang tight. Okay, we'll start off with now this was for this weekend. It does not include today's prices, at least with the market cap. I say I like to do these every week or so. I didn't do one last week and need to play catch up, but I'll give you a basic rundown if you didn't see my previous updates. Maybe you're new to the group or something. All right, so don't worry too much about these right here. This is total trailing 12 month and total next 12 month. I have kind of my own formulas I run to figure these out. They are market cap sensitive, or at least this side is. And basically with market cap weighting factored in, right now, I'm expecting 18.71% earnings growth from the entire S&P 500 over the next year. Um, that is up from last time I gave an update. I think last time I was at 17.5 something, or I forget. It was in the 17, up above 17.5 range and below 18. So it's gone up quite a bit over the last 2 weeks. That's a good sign. Again, that's more positive price growth for that we can expect in this sometime in the future here. Okay, now this one over here is, as I mentioned before, this is the equal weight thing. Basically, where I'm not factoring in market cap weighting. If you just straight across the board, just based on just raw EPS data for all the companies in the index, it's actually 21.5%. So what that basically means is that the heavier hitters are expecting healthy earnings growth, but not quite as strong as what the broader index is generally expecting in a way. That's the way you can look at that. All right, so also looking at this with market cap factored in, current value of the index I have at 38.65. We actually saw that price for a little bit today. Um, it's not the highest price we've seen from the index, but it's where, now current value, if you're new to here, that means that's where I think the index is reasonably priced in a zero growth environment. That means if we don't have 18.71% earnings growth expected, but just flat, just nothing, no growth expected, that's where I would expect the index to be topping out. But with this earnings growth factored in, what you end up getting here is the future value, 45.90. Basically, a year from now, this 38.65, I expect to climb to as high as 45.90, or we could say about 4600. Quite a bit of gain there, if you have to, needless to say. 12-month price projection now is up to over 5,000. Basically, based on this earnings growth figure, a year from now, a reasonable argument can be made for the S&P to get as high as the 5,000 level and be reasonably priced if this earnings trend stays the same. Okay, on equal weight factor there without market cap, it's 29.75 is what my value is, which is way down from where it's currently priced. But again, this is a market cap weighted index. It's going to bias in favor of the higher market cap companies. Future value 36.15, so that's where part of that factors in. Now, I'm not going to talk about, well, I guess because I might, yeah, I'll have this in both the swing trade and the main groups more than likely. I will talk about swing targets for those of you guys who are in the swing group. I don't recommend you guys in the main group focus so much on this. I don't want it to confuse you guys too much because these numbers are already confusing enough. But since I want to have one video for both groups, I'm going to cover this for you guys. Okay, so swing traders. Basically it means that you can reasonably price in the index as high as 42.30 before I say it's starting to get overpriced. And and then these swing in targets are, right now 38.05. We saw that early this morning, well, at least on the S&P futures side, from what I saw. So we could arguably say that it's high volatility, and even more so with the Nasdaq in correction territory. I've not ran the numbers to see. I think the S fund also did get into correction at one point. I could be wrong though. I didn't really pay that much attention to it, but needless to say, the earnings data is there to support much higher prices than we have. So just hang in there, and we'll see them eventually. Okay, we'll move on now. All right, so this is what I'm expecting quarter by quarter from the S&P 500 earnings. This is the equal weight side, and then this is the market cap weighted side, which is the one that matters more to us. So right now, you can see how it's trending upward up to over 4,500 a year from now. And quarter by quarter, what this is, quarter percent basically is comparing this 1196 to the 893. And then the 939 to the 660, basically the same quarter the previous year it has to go by for that. And then 12 months, you see we have good strong growth coming, actually that we just had this quarter. We'll talk some more about how much of the index is reported and what they've done on another slide here coming up very soon. But as far as quarterly performance, the next two quarters are going to be very extremely strong, and then it'll taper off to a slower growth number 4 quarters ahead. Basically, that's all we really need to get from that. All right, so beer data. I have not updated the announcement posts yet in either of the groups, but I will be. I will have new these price targets as well as this beer data updated. Now, those of you guys who are not familiar, beer stands for Bond Equity Earnings Ratio. Basically, it's a comparison exactly what you see here. Stock earnings yield of 1871, which was that number right there. And bond yields, what this is what the 10-year Treasury notes current yield is. What it does is it gives an implication of which is more favorable to invest in, which one has a higher implied yield on your investment. And this is, now I did have it at 95% stocks, 5% bonds, but with these recent changes, even with stock earnings yields going up even more by a full percent more up to 1871, the fact that bond yields are going up the way they have been actually pushed it, changed it to where it now it's down 90% stocks and 10% bonds. So if you want to take a diversified approach, maybe you're at or near retirement or something, and you're a little bit more risk averse, I recommend you follow what I have on this. I do always have in the main announcement post, a diversified distribution, at least in the main group. What I recommend based on this, and you will see, like right now, by the time you see this, it'll be changed. But as of me talking right now, it still says 95% stocks and 5% bonds. But by the time you see this, I will probably have that announcement post changed to where it's now 90% and 10%. So periodically, as these earnings yields, basically as stock earnings yields come down and or the bond yields go up, you're going to see it gradually shift more and more from stocks toward bonds. So when it starts to look like bonds give a better yield than stocks, By then, if you're following that diversified strategy, then you'll probably already have more than half of your money in the bond funds, G and F fund, and or F, then in stocks anyway. And then if a recession and a bear market come, then well, you don't have so much to worry about because most of your more than half of your money will already be in the bond funds anyway before that even happens. Now, yeah, there are pros and cons to every strategy, so you gotta accept that sometimes I mean, if you scale back early, you're gonna miss out on some gains that other people will be able to see. However, when a big drop does come, then you might not lose as much either. Long term, I can't quantify for sure what would give you better results. I'm not against having yeah, somebody who's good with numbers, preferably, who's willing to even just do simulations. Because I have enough on my plate, but if you're willing to do simulations or even just follow this strategy with your own account and tell me how it's doing for you, or and you gotta wait. Yeah, it's gonna take a long time. Wait for other conditions to come up, like a bear market to come, and then wait for to bottom out and come back up again, and then see how things work out for you. Then, do you find that you're starting to that you're avoiding some losses before they actually come, and then are you able to get back in on the larger gains before the stock prices get too high? I suspect you'll have a harder time getting back in on the stock prices when they rebound, when that does happen. I'm not saying it is going to happen in the near future. I'm just saying at some point in the future, it probably will happen because the bear markets are regular, just occasional thing that does happen. All right, well, moving on though. This is mainly for those of you guys who invest in IRAs and individual stocks. Just as always, these are the 11 sectors that the S&P 500 or most other indexes break down into. I say most others because some stock indexes specifically include certain sectors. I think like the NASDAQ, if I recall, specifically excludes the financial sector. I think there are others that are also not so well covered. Um, yeah, so in a nutshell, though, S&P, these are what you call GICS or GICS sectors. And so the S&P 500 itself is just an average of what's going on between these 11 sectors. So some of these sectors are going to outperform the index and some are going to underperform the index. So if you're in an IRA or have a regular taxable brokerage account, where you can invest in regular stocks or sector industry ETFs or something, I post this just because it might help you guys out and figure out what ETFs to focus your attention on, or what kind of stocks you might want to pay attention to. You might have seen that energy stocks have really taken off over the last few weeks, done very well. And this, it's doing exactly what this earnings thing here is telling me. That's a good place to be. Industrials, that's primarily driven by the transportation stocks, and that's always a good thing because there's a saying that as go the transportation stocks, so goes the economy. So if transportation's doing well, then the economy must be doing well as well. So that's a really good sign there. Consumer discretionaries and consumer services. Now, consumer services is probably driven mostly by Amazon. I mean, if I recall, that is the sector they belong to now. But just it's just to help you guys out here, so you can hopefully get outperformance from those other accounts outside of TSP. Uh, Again, try some of this out and let me know what kind of results you guys are getting. Is this information working for you, or is it helping you, or are you finding out there are any problems or whatever? And give me feedback, and then we can find out if it's tail wagging the dog, or if it's really doing what it's really supposed to be doing. All right, so moving on here though. Okay, looking at the quarterly update, we're almost done. We're getting all the earnings data for the quarter down here at the bottom. 490 of the 505 symbols have been covered. There are 500 companies, 505 symbols. 5 of the companies in the index have 2 share classes, and both share classes are factored in, at least on my data. All right. As a whole, they're up 4.12%. Just raw data. And, it's not bad. You can see, just kind of compare along these other percentages where it stands. All right, and then 302 of them have posted positive results. Basically, their earnings this quarter are improvements over the same quarter last year. 7 are neutral and 181 are negative. That's 61.6% of the index has reported positive earnings growth. So you guys might a lot of times hear about, oh yeah, only the index or the market's only being held up by the FANG stocks or something. Okay, well, here's the data to prove that that's not the case. If that was the case, then something like this would be it, or even lower. Now, 40.6% of the index reported positive growth in third quarter of 2020. Right now, we have a very normal amount in the low 60s. Which actually, if I put this on a chart, you would see that it's right about in the middle, roughly. It's not a bad area. It's not a bad number to have. So overall, we're in good shape. The data is showing that it's trending upward. It trended downward when the market took a dump back last year, like as it should have, and then now it's trending upward, just like it's supposed to as well. So the price is basically overall, not looking at most recent price performance, but as far as over the last quarters, the trend that it's taken is accurately reflecting what earnings are doing in general. How much is it? How closely in line is it, or is it skewing the results one direction or another? That's debatable. You can talk to anybody and get different results, but my information here says that prices are actually lower than they actually could be. All right, moving on here. Let's see. Today is the 8th, I believe. Yeah. So we don't have much going on for earnings this particular week. Only 3 companies are on my radar this week, and they're not until Wednesday and Thursday. And then next week, we have only 7 companies reporting, and those will be all on Wednesday and Thursday as well. And then the following week, only 5 companies, and then 6 companies at the end of March, going into the 1st of April, and then you see only 2 into the first full week of April. After that, it'll probably start picking up again into that, because that'll be the second quarter of April. All right, looking at bond yields again. I know this is a lot of mumbo jumbo. I'm more interested in you looking at what the trends are and not necessarily what the actual numbers are. The most recent prices down here does not include today. I have not updated it yet. I prepared all this material over the weekend. I just didn't get a chance to record it. So, mostly what you see here is continuing to kind of flat trend here on the shorter term bonds, as you see. Might be starting to trend back upward a little bit here at the 1-year mark. Definitely starting to trend back upward on the 2-year. So that's, kind of a positive sign there, because if it starts to, as these all start to trend upward, especially the 1 month, it might start trending up more toward like 0.25%, and that would mean it's more of an indication that the bond market is betting that the Fed is going to increase bond rates or increase the Fed fund rate. It's right at or near 0% right now, but there will be a point in time when the Fed meets up and decides they're going to raise the interest rate of 0.25%, and quite often the bond market accurately guesses when that's going to happen. You'll see the bond yields actually doing that before they actually even do it. In many cases, from what I've found. Okay, now with the longer term yields, these are the ones that are what are causing the most problems with the market in the short term, which I'll get into more in a little bit. But more interest to us is what is the more recent trend. Uh, Kind of up and down there from what I'm seeing. It's trended upward, for sure from January 19 to today to this weekend or last Friday. But as you see here, we did have higher on February 25, and then it trended back down and then came back up. So it has not eclipsed those numbers yet. Well, this one did. The 10-year yield. It's still at I guess, a short-term new high. This is far from a record high, but as far as recent trends are concerned, it is still higher. 20 years still going up, and 30 years well, yeah, it didn't reach its previous day's high, but as you can see, it's still trending upward. Um, so we'll go. I'll cover that on the next segment, but well, basically, this is really it's just a projection of inflation, and then when you have inflation, prices go up, but so do corporate earnings, more than likely. And, because, when you're paying higher prices for stuff, then guess what? You're paying more to the companies that report their earnings that affect their share prices and S&P 500 and whatever other indexes they might be in. All right, so inflation is not necessarily a bad thing. It's just is it out of control, and this isn't going to tell us what the actual inflation data is. It just kind of gives bond market tells what they're expecting inflation to do more so than what inflation really is doing. Again, they could be pretty accurate at times, but then now the question there is when is this trend with rising long-term yields going to stabilize? Investors basically don't know where to invest their money. They want their money invested, they just don't know where to put it because the higher PE or higher price to earnings ratio companies are the ones that are getting hurt the most, which are the tech stocks. And they might want to put that money into something else that's a better value, like a lower PE company, but I get the impression they're still biasing toward the tech stocks, and they want to really have their money in the tech stocks, but don't want to do it until these bond yields stabilize, and so they know that their money will still be okay in the tech stock sector. All right, so 2-year versus 10-year yield, that's one to always look at. You see it's still stretching out, which is still an indication that longer term yields are going up, while shorter term yields are not doing so much. Um, when the twos and tens, when it inverts or turns negative, that tends to be an indication that a recession and bear market could be coming within the next 9 to 24 months, generally speaking. Doesn't mean that it's definitely going to happen, but quite often when that does happen, that does tend to result. Right now, we're going in the opposite direction, though, so that's not really an indication of anything that I'd be concerned about as far as recessions and bear markets are concerned. Sure, we might get corrections, but corrections don't last that long. They scare the heck out of novice investors, but present great buying opportunities for people who are experienced investors. So those of you guys who are novices, keep that in mind. Prices drop if you're not retired and you're contributing. Guess what? You're buying cheap shares basically of your stuff, and you're going to get higher pips than what the funds themselves are doing when you're doing that. All right, moving on here. Now we got this is just a chart representation of what you just saw on the March 5 bond yields. Short-term yields over here on the left and long-term on the right. Uh, Again, I show this mainly is to show if there's any kind of inverting going on. Tends to be, if there is ever, it's normally around here in the middle section that go down first, or um, that lag, I guess, in a way with the yields relative to the short and long. When short-term yields get up above long-term yields, that's what you call an inverted yield curve, and that's where people start getting concerned about recessions and bear markets. Okay, last I want to talk about a certain indicator here, I guess, or well, actually, yeah, it's an indicator. I'll just call it that. TNX is the ticker symbol for it. It's the 10-year Treasury and Treasury note here. If you follow it, basically this number here is usually always 10 times what the Treasury, what the 10-year yield currently is. So what this implies here is that the 10-year yield closed at 1.59% today. I can go on to a certain website and show you what it actually closed at, and let's see and confirm that that's the case. But I'm more interested in showing you right now what it did today. It was actually pretty flat overall. It spiked up after hours, as you see here, but from here on, you see it stayed pretty much flat, right around that 1.59 maybe ish. Yeah, let's see, 1.1592 on up to 1599 or so, or somewhere in that range most of the day, with the exception of this period here, from about 11 o'clock to about noon. For about an hour or so, then around midday, it went up above, up to as high as what, at 1606, somewhere in that ballpark. So it did get up, but it's been mostly flat, which is a nice thing to see. Now over here also, yesterday spiked up during the after hours period, it looks like, but then what happened during the daytime? It gradually continued, trended downward most of the day. So to me, that looks like a kind of a decent sign that they might be trying to stabilize. Without looking at other days of data, I can't really say for sure, but and I do want to show you this. All right, so as a whole, bond yields were kind of all over the place over here back in March, basically right around when the pandemic started, and they spiked up a little bit here and started trending back downward until about the end of the first week of August. And then they jumped back up, and now you see I have all these different trend lines in here to show you what they've been basically doing, and you see the trajectory's been going upward more and more. So it started trending upward consistently right here, and then when it got to this point in January 4th, it started to trend more strongly upward. Yet here again around January 28th, it accelerates even more, and then even more. So are we going to get another upward, even greater, stronger trend? That's what is going to it's going to present itself as concerning to investors. Might look as possibly panic selling or something, and even cause a legit correction or something. Well, not legit, but could cause a correction on which is a 10% drop in prices on stock indexes that haven't already done that. So there is that concern. I know Dario already posted his. He had a more bearish sentiment that he posted this evening before I worked on this, and I'm not saying that I necessarily agree with him, but there is a possibility that he could have good reason to have that sentiment. Is all I'm saying. I have reason to be bullish as well, but being realistic here, I can see both reasons for either direction. And until these actually stabilize, these yields stabilize, and stop confusing investors is what it really boils down to. So investors can have an idea where to put their money. Okay, so basically, as long as these bond yields keep doing what they're doing, they're confusing investors, and it doesn't necessarily mean they're going to panic. They just have their money pulled, and they want to have it invested. No good investor wants to have their money sitting around doing nothing useful for them. They always want to have it somewhere, but they want to have it invested somewhere where it's actually going to do them good. And when they can't figure out where to put it, that's what happens. There are good buys out there. They're just trying to figure it out, and they can't figure it out as long as the bond market is doing what it's doing, and making it hard for them to figure out where exactly they want to park their money. like I say, I think they're biasing more toward the tech stocks, if anything. Kind of want to have it there, but feel like they can't because of what's going on with the bonds, and maybe other types of stocks might be a better place for them to be, but they're just kind of reluctant to do it because they're so fixated on the tech stocks. All right, so sooner or later, though, this is going to normalize. Either they'll rotate into other sectors, which some of that's already been happening. Like say, energy sector, industrials, those transportation stocks and energy and among others are doing well. I talked to Feliciano earlier today. Some of you guys know him. Um, he had pointed out to me that I think 120 of the S&P 500 companies hit new 52-week highs today. So that's a positive. That's a good sign. I mean, I like to see even more breadth than that, but it's I say it was previously a lot less than that, down in like even single digits, I believe, not long ago. So 120 companies hitting new 52-week highs is an excellent sign. All right, so all right. That's all I have mainly for this. Don't be afraid of what's the. It's in close. Uh, don't be concerned about what's going on long term. The prices do have plenty of room to go upward, and they will go upward. It's just how long is this? Is this confusion, or whatever this drop is right now? How long is it going to last before they finally get it figured out? Stimulus, I don't know. That really has some. I'm sure that has a factor in it, but it's the inflation. I think that's mainly driving this, and we'll see what the Fed actually does too, because the Fed traditionally does raise the Fed funds rate to help control inflation. So, and they actually have talked about possibly selling off some of the short-term bonds in order to fund purchase of some of the long-term bonds to help flatten the curve out a little bit, which is what is typically done. Uh, and that's what also can tend to lead to inverting the yield curve eventually over time. Not even 2% yields that we have right now, so this is nothing even to squawk about, to be, in my opinion. 3%, it tended to freak people out, in the recent past, and even then, it's like, what's 3%? That's barely even half of what usually these yields are at when a bear market starts. Yeah, usually they're up in the mid fives and even over 6% uh, when the bear markets come. So these kind of yields shouldn't be too much of a concern. They might be more of a concern for dividend paying stocks, because now it's 3% yield on safer money, if you will, where the risk is of default and not so much volatility, versus dividend paying stocks. Then there's that risk that they might reduce the dividend or something along that line. Not that they will, but there's a chance they could. So if you have a bond yield of 3% and a dividend yield of 3%, some investors are going to go for the bond yield instead, because it's a safer bet than the dividend. And it's kind of how that'll work. And then what I've been hearing is the high PE stocks, like you say, with the tech industry, is what's mainly getting hurt the most right now. As you see, the tech sector is in a correction right now, while other sectors are doing well. So it's just focus your money where you can. If you're outside TSP, where it's going to do you good, and hopefully this information will help you. If you're only in TSP, then like I say, if you're on the buy and hold side, particularly in the main group, just don't worry, don't panic. Stick with the CNS funds like we talk about. iFund has been doing fairly well recently. I'm going to have to keep paying attention to the economic data. I haven't checked that. I have to update that still. It was looking better, but still not as good as the U.S. reports. So I would still personally favor the CNS funds, even though iFund has recently done well. All right, I think that's about all I have for now. And You guys all have a good day, and we'll have another update. Might not be next week or really until next month, because as you saw on the data, we're already only about 10 to 15 companies away from being done for the month. And that's not really going to change my numbers much. The only thing that will change my numbers will be some of the share prices, and how much a particular company has influence on the index. So don't expect much to change on these price targets between now and next month. All right, so that's all for now. Hope you guys got some good information out of this. Enjoy watching, and we'll see you guys next time. Thanks.